15% of purchase contracts collapsed this summer. That's not a typo. It's the highest cancellation rate we've seen since tracking began, and it's happening in markets across the country. So if you're planning to buy or sell in 2026, ignoring that data, it could cost you big. I'm Jim Sheils with Southern Impression Homes. Let's unpack this trend and really what it means, where it's hitting the hardest, and what you should do to be able to navigate the waters. In July 2025, Redfin reported that 15.3% of U.S. home purchase agreements were canceled. That means roughly 1 in 7 deals fell through. This isn't just a July anomaly either. In June, the rate was 14.9%. In September, 15% again. This trend is consistent and seems to be growing. So let's talk about where this is happening. In San Antonio, 22.7% of pending deals were canceled in July. In Fort Lauderdale, it was 21.3%. Tampa, over 20%. These aren't small towns. These are real cities, and these are some of the fastest growing metros in America, but still buyers are walking away mid-deal. Imagine this. You're a seller. You finally get an offer after weeks of showings. You accept it. You plan to make your next move, maybe start packing. Then the buyer backs out. No explanation, or worse, you find out their financing fell through. You're relisting, you've lost your momentum, and now you're possibly starting to drop your price. On the buyer side, people are scared. They're uncertain about their jobs, interest rates, political unrest, all these future values. So they sign that initial contract, then they cancel. And that's not just market noise, that's emotional paralysis. Redfin now forecasts a 1% drop in national median home sale prices by the end of 2025. June already saw a 0.1% monthly dip, and it's not a crash, not yet. But for many metros, it's a clear signal. Pricing power is shifting. Sellers who refuse to adjust are sitting, buyers are hesitating, and agents are caught in the middle and are getting burnt out. Some headlines scream about rising inventory. Let's clarify, though. In 2019, a balanced year, there were 1.25 million active listings, okay? Today, there are 1.1 million. So that's still below pre-pandemic norms, and we're still short a total of about 4.7 million homes, especially in the affordable sector. So the issue isn't too many homes, it's too many overpriced homes in that emotional range that I always talk about, the higher priced, fancier homes that were overbuilt during the pandemic, because people thought that they had free financing and now they're stuck in them. And the people can't afford to get into those houses now and people are stuck in them. You'll hear the normal promises, that usual mortgage rates are falling, the buyers are coming back. But here's the truth. It depends on the market. And even after 5 rate cuts, pending sales are still down. Mortgage applications, they might tick up some, but contracts have been collapsing. Lower rates are not enough. Buyers want value, and that value has to come through the type of property they're getting and how much they're willing to pay. They want that security, and they want homes priced to reality, not the ancient memories of years past. So what are we doing at Southern Impression Homes? Well, we're not waiting for the market to normalize. We're building for what the market has existence for right now. And that means affordable properties, single-family home rentals, duplex rentals in growth markets. Then we're making sure construction costs have control to protect our margins. And we're structuring offers that include incentives and contingency planning. So if you're selling, you're going to have to drop your ego, price it to move, not to brag. Again, especially if you're in one of the emotional properties. Emotional properties priced 100%, 150% above the median value for your area. A lot of those sold in COVID. The low interest rates really helped. And now it's tough to make the numbers work affordability range-wise for a lot of people buying there. So you're going to have to drop your ego, drop the price. Second thing is you might have to expect some cancellations. Don't think it's like the end of the world. It may happen. Just recover from it, learn from it, move on quick, and have backup offers lined up. And then also, offer repair credits or rate buy downs up front. If you're willing to offer some repair credits or even credit them to buy down that rate that's feeling a lot higher today than it was, let's say 4 years ago, that can help move your property. And work with agents who understand current data. If they're working off the 2021 playbooks, that's not going to help you. If you're buying, know your comps. What are the real values? What are the real prices? Don't chase hype, chase value, and use cancellation trends as a negotiation leverage. If things are canceling, step in, make an offer right behind one, and secure strong financing with contingency clauses. That gives you a little bit more protection to step out if the deal doesn't work for you. And I'd really tell you to consider areas with higher cancellation rates. Why? Because these sellers are more motivated. Not every part of the market is declining. In fact, affordable housing is the strongest segment right now. That's where the deepest buyer pools exist. Most people that are waiting for a home are looking for affordability, and they also have the range to be able to pay for that. But the luxury homes, like I keep saying, especially those priced 2x of the median, those are sitting. You got to be careful with that. If you're investing or building, your focus should be here, median-priced homes or below. Safe neighborhoods, you can walk at 9 o'clock on a Friday night, not be afraid. Growth metros in Florida, Texas, and the Southeast. This is where the affordable housing trends are going, not with just smaller builders, but larger builders and the institutional fund groups that have the most amount of money and the most amount of analysis to be able to determine where's the best place to put capital at a safe and stronger chance for return. This is where rent stability is, and long-term appreciation still makes sense. This isn't 2008. We're not seeing mass foreclosures or reckless lending again. What we're seeing is a reset. The market is recalibrating around affordability. The builders, the investors, and the buyers who recognize that early will be the ones positioned for long-term growth. This period of uncertainty is also a period of opportunity. If you're a buyer, seller, agent, or builder, and you want to know how this shift affects your market specifically, let's talk. At Southern Impression Homes, we track this data down to the zip code and nationwide. We're not guessing, we're adapting. Message me today for a custom strategy based on where you are and what you want to achieve. The next 6 to 12 months are going to separate the pros from those who panicked, so let's make sure you're on the right side of the line for this opportunity.